All right, let's check out your Chapter 10 homework. There are 20 questions in this particular homework, so I'll probably most likely will divide my videos into two separate videos just to keep it a little bit shorter for you. All right, so here is problem number 1, and on this particular problem, it deals with an installment note payable. So the basics of this is they want you to show the preparation of how the payable would look like on the balance sheet. So it said that they had used a promissory note. They borrowed $1 million. This was on July 1st, 2018. The interest rate was 6%. The note is to be repaid in yearly installments of $200,000. What that means is that every year they're going to be paying back $200,000 of that $1 million principal, plus any accrued interest. So then it says on June 30th of every year until the note is paid in full, on June 30th, 2023, they want to show how the results of this transaction would be reported in a classified balance sheet prepared as of December 31st, 2018. So notice the time period here, it's July 1st and then December 31st. So again, that's 6 months later. So we're going to have two sections. We're going to have the current liability and of course the long-term liability. So of the $1 million, because $200,000 of that is going to be paid off in the current year, $200,000 of that will be put as a current liability, and then the other $800,000 will be put as a long-term liability. So this $200,000 and the $800,000, that's where they get the $1 million. But remember the $200,000, because it'll be paid off in the current year, that part will be considered current. Now, in terms of the interest that they would have accrued, and again, that would have been as of December 31st. Remember, it's July 1st through December 31st. Here's your principal times rate times time. So it's $1 million, which was your initial principal, times that 6% annual rate. And then the reason they divide 6 over 12 is because of that 6 months. So again, July through December is 6 months, 6 over 12. That give you $30,000. They haven't paid it yet, so that would be an accrued interest. So that interest payable, because it's going to become due pretty soon, because you're going to pay that along with that $200,000, that'll be also considered a current liability. All right, so that would be my comments on problem number 1. Let's check out problems number 2 and 3. These are combined. This problem is going to be dealing with deferred revenue, and they want to show you how this impacts, of course, first the accounting equation. So let's check out what they've given us. And they tell us that this is the Tennis Times. It's a publisher of magazines. And it says its accounting policy for subscriptions follows. So it says revenues from our magazine subscription services are deferred initially and then later recognized as revenue as subscription services are provided. So that'll be basically, that's your matching principle. That's the idea of you report revenue when you've earned it, if you go back to that 5-step model of revenue recognition. And so they're going to collect money in advance. So it says they had collected $420 million. This is for 2018. And then that will be distributed later. So the revenues will be earned in 2018 and in 2019. So then in part B, they're telling you exactly how much of this $420 million will be earned. And in part B, it says $204 million would have been earned in 2018. And then $216 million is earned in 2019. So the impact, first of all, on your accounting equation. So notice that they got the cash, so that would have been an increase to your assets initially. And of course, that would have went right into your deferred revenue. Remember, that's a liability, that's an obligation. So that would be your initial effect on part A. And then as they start to earn the revenue, they would reduce the revenue. So here's your reduction of your revenue, $204 million. And of course, increasing your service revenue for $204 million. And then the same thing in part C, you're decreasing your liability and then increasing your revenue as you earn it. And then the second part, they just want to show the journal entry aspect of it. So the first part is debiting cash, crediting deferred revenue. And then the last two, notice it's the same entry, just the different amounts. You've got the debit to deferred revenue, which is your liability, and a credit to your service revenue, which is your revenue. And again, this is for the amounts that they've earned in the respective years. Okay, so that'd be my comments. That's number 2 and 3. Let's check out number 4. So number 4 will be dealing with a bond. So in this problem, they tell you that they had issued, again, this is January 1st. You always have to watch the dates on the bond, because lots of times you may have to do something with interest. So the interest, sometimes you have to accrue interest between when a bond was issued. So always watch the date when the bond was issued. It's a $500,000 in bonds, so each bond is worth $1,000. They mature in 10 years. They tell you that the stated rate on the bonds 10%, and the market rate's 10%. So if you go back and review the PowerPoint lecture, remember, anytime the stated rate and the market rate are the same, these are considered to be issued at the face amount. They tell you interest is paid once a year. They need to tell you that interest is paid once a year, because if they said twice a year, you'd have to do something with that interest rate of 10%. You'd have to divide that in two, because again, that 10% would be an annual rate. But in this case, it's just paid once per year. So part one says determine the price at which the bonds were issued at the time of issuance. Of course, the price is going to be $500,000. Put that right there, because remember, the interest rate, the stated rate on the bond, sometimes they refer to that as the contract rate, but the stated rate is the same as the market rate. So these are what they call face amount bonds. Now, in the second part, to show you the actual journal entries, it's pretty simple on the face bonds. You simply debit cash, credit bonds payable for $500,000. Notice this is January 1st. Now, at the end of the year, you have to record an interest payment. So the interest payment, remember, it's your principal, which is $500,000, times the interest rate. So remember, for the bonds, it's to get the interest payment, you always multiply that by the stated rate, which is 10%. And in this case, it's for a whole year. So then you just multiply it by 1 or 12 over 12, and that would give you the $50,000. So again, think down below, they'll show you the actual calculation if you want to see it, which is right here. So again, here's the principal times that stated rate. And again, the reason they're taking it 12 over 12 is because it's January 1st through December 31st, and that's 1 year. So you could have just multiplied this by 1 for 1 year to get your annual interest. So $50,000 would be your interest payment. And what they do is they simply debit interest expense and credit cash for that $50,000. All right, I think that's it on number 4. Okay, check out number 5, very similar. They tell you right off the bat that they issued again January 1st, issued $200,000 in bonds at face value. So we already know that the stated rate and the market rate are the same. So they have to give you the stated rate if they want you to calculate the interest, with the stated rate of 6%. It says the bonds mature in 10 years and pay interest again once per year. Again, they will typically tell you how often they pay the interest, whether it's once a year, sometimes it's twice a year. So the first entry would be how to issue it. You just simply notice it's January 1st. You debit cash, you credit bonds payable for that face amount, which is $200,000. Notice, regardless of this was a bond premium or a bond discount, anytime you issue a bond, the question comes up, what did you credit bonds payable for? Bonds payable will always be credited for that face amount no matter what. So part 2 is just your interest payment. So remember, on your interest, it's the principal amount, which is $200,000, multiplied by that 6%. And then, of course, it's 12 over 12 again, or just multiply by 1, because if they want the interest for the whole year. And, of course, you would get $12,000. So, again, that calculation, I'll show it to you. It's right here. Principal times rate times time. All right, now, the last one on here is they want you to retire the bonds. And they're showing you, I'll first show you the entry, and then I'll show you how they got it. So they want to retire the bonds at a quoted price of 101. That means 101% of your face value. So notice that they would be debiting bonds payable, again, for $200,000, because that's the principal, that's the face value. They're crediting cash for 202. The way they got the 202 is they took that 200,000. I'll write this up here. They took that 200,000 and simply multiplied it by 1.01. So that would have been the price, that would have been the cash payment that they would be paying to retire these bonds. So the way you determine a gain or loss is you look at the carrying value. And the carrying value in this problem was always 200,000, since it was a face amount bond. And then you look at the amount that you're paying in terms of cash to retire it. So in this case, if they're paying $202,000 to retire a $200,000 bond, that of course would give you a $2,000 loss on retirement, and that's where they came up with that. So you would debit the loss on retirement for $2,000, And of course, you would be crediting cash for that, the amount that you agreed to buy back, which is 101.01% of the face amount. Okay, that's it on number 5. Let's check out number 6. We're going to be looking at the ratios in this one. So on number 6, they give us 2016 and 2015. This is for FedEx. They give us our assets, liabilities, interest expense, income tax expense, and of course, net income. So they want the debt ratio and the times interest earned ratio for each of these. And just to kind of show you, first of all, we'll look at the actual, how do you calculate them, and then we'll answer the questions. But notice, remember on the debt ratio, it's simply your total liabilities divided by your total assets. Very simple calculation. So you just have to divide for both 2016 and 15. Liabilities is the numerator, assets is the denominator. For 2016, you get 0.7. In 2015, you get 0.59. On the times interest earned ratio, here's your formula: net income plus interest expense plus income tax expense, and then divide by interest expense. And so in this case, what they did was, you've got, here's your numerator for 2016 and 15. And of course, you divide by 340 and 240. And if you go back up above, and you can see the numbers you would just have to plug in to these two cells here for both debt ratio and your times interest earned. So then once you do that, again, just make sure you can see it. Notice again, for times interest earned, it ended up being 9.06 and 7.79. So for the debt ratio, because it did increase, went from 0.59 to 0.7, you know, I like their explanation. It suggests creditors are providing a greater proportion of financing for their fixed assets. So they're borrowing more money for their fixed assets. So sometimes that can be kind of risky. Typically, this number, you watch it pretty closely. You don't like it to be more than 0.5 if you can help it. Times interest earned increased from 7.79 to 9.06. This means that they are more successful in covering their interest costs through a profitable operation. So times interest earned, again, looks at their ability to make interest payments. But if you think about it, why would they be making interest payments? Because they have debt. So these two ratios kind of go together. It's telling you how much your financing is. But then this one is then going along with it to tell you how able are they to make these interest payments. And sometimes these interest payments can be huge dollar amounts, huge amounts of cash flows off the books. All right, so that is number 6. Number 7 is back to just a bond. This is a simple bond problem. On this one, it says that they have a bond director. They quoted a bond price of 130.03. It says the company's 7.45% bonds. That's the stated rate on the bonds. They mature in 2031. So the question says, what were the bonds listed as a discount or a premium? Remember, this amount is always as a percent of face value. Anytime that is over 100, it's going to be a premium. If it's less than 100, then it would be a discount. So, of course, number 1 would be a premium. Excuse me. And then on number 2, it says, does this mean the market interest rate for convertible bonds was higher or lower? Well, if it's a premium, that means that the stated rate would be higher than the market rate. So a market rate in this case is obviously going to be lower than the stated rate, because investors are willing to pay more for these bonds, which of course pay more interest. Okay, so I think that's it on number 7. That was a short one, no calculations on that one. All right, number 8 is again looking at your balance sheet preparation or presentation. And let's check this one out. Notice it says they're going to issue a 500,000 10-year 4% bonds, interest payable annually on December 31st. All of the bonds will be issued on January 1st. Show how they would be reported on January 2nd, 2019. Balance sheet if they're issued at 97. So there's 97, that's below the face, that's below 100. So this is going to be a discount bond. You take 97% of 500,000, which is showing you right here. So that's essentially how much cash you're going to be getting. And that amount turns out to be 15,000. So that would be the discount. Notice the bonds payable always shows up as the face amount no matter what. So the way it's presented on the balance sheet is the face amount of the bonds minus the discount, which is 15,000. Again, 3% of 500,000 is 15,000. So the carrying value to start on January 2nd initially would be $485,000. Okay, that's number 8. Number 9, same type of problem, but they want to show you how the premium would look. So they do it again, 500,000 bonds, 10-year, 4%, payable interest annually. All the bonds are shown on issued on January 1st, and here it is. They're selling it at 102. So it's 1.02 times your 500,000. That's going to give you 510,000. So that 10,000 is above your face. So that 10,000 will be called a premium, because in these bonds, apparently, the stated rate of 4% is more than the market rate. So the carrying value would be the face amount plus that premium of 10, which is being sold over the face. So 10,000 more than 500,000 is called the premium. You add those two together, the initial carrying value will be $510,000. All right. The next one, I believe, is actually 2 questions. So it's 10 and 11, and then I'll do a quick pause, and then we'll do a part 2 of the homework, because I believe there's 20 questions in total. So on this one, we've got, they issued a 25,000 10-year 5% $100, that's the face amount of the bonds, on January 1st, again at face, interest payable each December 31st. So again, notice when they issued it. So they want you to do the issuance of the bonds on January 1st, and then of course the first interest payment. So they break this down into 2 parts. The first part they're showing you is, first of all, how it affects the accounting equation. So you know, first of all, you borrow the money, so you'd be increasing your cash by 2.5 million, and then crediting bonds payable for 2.5 million. That's just the initial issuance. And then of course the interest part of it will be simply that 2.5 million. It's a 5% bond, so you take that times 5. And then of course, this is for 1 year, I believe. It says interest payable on December 31st. So all you would have is a cash payment, and then of course you'd have interest expense on your equity. So on part 2, just to show you essentially how they came up with the journal entry. Again, these are face amount bonds. You just debit cash, credit bonds payable. Again, for the face amount, for that 2.5 million. And again, it's since it's 25,000 bonds, you had to multiply again by 100 to get that 2.5. That's the total value. Even though the face amount on each bond is 100. So that, again, there's your 2.5 million. And then again, here's that principal times rate times time calculation. Principal 2.5 million times your annual interest rate on the bond. 12 over 12 is for 1 year. So again, there's where you're getting your interest expense debit, and then credit cash for 125,000. All right, so let me pause this, and then I'll do a part 2 homework video where we will start up with question number 12.